CEOs voicing varying degrees of concern over President Trump's tariffs as second quarter earnings season kicks off in earnest. Goldman Sachs CEO David Solomon warning of a markedly different operating environment. Meantime, DHL CEO Tobias Meyer telling Bloomberg companies are, quote, a bit tired of the changes. Joining us now with more on the president's trade policy, we've got Andrew Siciliano, KPMG Trade and Customs Global Practice Lead. And we also have Marco Casaraghi. He is Evercore ISI's senior economist and strategist. Thank you both for being here. I also want to bring in my co-anchor for the hour, Thomas Hayes, Great Hill Capital chairman and managing member. He will be joining us for the interview here. So, Andrew, I want to kick it off from you. What are you hearing from CEOs at this moment?
It's been tariff whiplash lately, and what companies are really doing is that not looking at this pause or timeout as just a pause or timeout. They're looking at it as an opportunity to build a resilient trade strategy. So that's what companies are doing. They're kind of going from reactive to readiness, getting ready for the next wave.
And Marco, come to me on that. I saw a stat this morning that our executive producer flagged. More than 60 CEOs expect a recession in the next 6 months, according to an industry group. Are you seeing that?
Good morning, and thank you for having me. So yes, I think the last week partial retreat on reciprocal tariffs has somewhat reduced the probability of a recession, which remains elevated by probably around like 35–40% as of now. In our central case, we expect growth to slow down to around 1% by the end of the year, and core inflation will be around 3.3%. So not an outright recession, but the economy is definitely weakening.
So I have a question for Andrew. What do you see CEOs doing? What's their strategy? Are they saying, we'll just wait it out and eat it for 3.5 years? Are they going to stand up factories in the US? And then what happens if policy changes 3.5 years from now? There's a lot of confusion. How do you play that? And do the big get bigger as the smaller players just go out of business? Or how are you thinking about it? How are CEOs thinking about it from large companies to small companies?
So there's still a lot of uncertainty until this plays out, right? So in terms of developing a resilient trade strategy, here's what companies are doing. One, they're finally getting access to all their trade data. If you don't have your trade data to do modeling, you're flying blind. So that's one thing. We're seeing companies look at the people that are in charge of trade and customs and elevating them to senior positions, VPs, directors, chief trade officers. You need someone in charge of the function, because customs went from back office to boardroom in a matter of months, right? And then lastly, just optimization of trade strategies. Companies are looking at every single strategy they can and really focusing on making sure they're doing it compliantly. So that's been the focus right now, those three pillars, getting ready in case the reciprocals come back in the same way they did. They could be less, they could be more, we just don't know yet.
Yeah, we just don't know. And Marco, I want to go back to you on this because we are, as I mentioned in the intro, really in second quarter earnings season now, truly kicking off here. To what degree do you think companies have the resilience to be able to still win over Wall Street this earnings quarter, given the uncertainty, Marco?
Yeah, I think, we have seen very large moves in the stock market, in general in financial markets last week. And I think that when that happens, we tend to focus on what happened today and what will happen tomorrow. But I think it's important to not get trapped in this narrow day-to-day narrative and take a step back to look at the broader picture. And if we do that, we will see that economic uncertainty has jumped much higher than we expected just a few months ago. And it's probably here to stay, as Andrew said. So even if tariffs go down this week because of some other exceptions, or some deals between the US and other countries, it would be very difficult for markets to believe this is the end of uncertainty about trade policy. And even in that case, uncertainty could simply extend to a different type of policy, like what will happen to the fiscal deficit.
Right.
And so this means we will continue to face this pervasive sense of uncertainty, which is a big obstacle for firms and households, and in general for economic prosperity.
And Tom has another question as well. Tom.
So Marco, when do you think we're going to see the pivot from the uncertainty of tariffs to the opportunity for growth with tax cuts, deregulation? In other words, package this up like Kevin Hassett was talking about this morning, maybe packages of countries all at once, put the pain behind us and now focus on growth, deregulation, tax cuts, et cetera. When do you anticipate seeing that pivot?
It's very hard to tell, right? I don't think as I said, I don't expect uncertainty to dramatically decrease in a very short time. I think uncertainty is here to stay, and I will not be so optimistic about seeing a lot of good impact on markets and growth in general once we move away from trade policy uncertainty to fiscal policy. Because what we have seen last week, for example, is that we have seen that global investors have probably reallocated away from the US to some extent. We have seen the dollar weaker and yields higher, which is something that typically happens in emerging markets, not in the US. So talks about massive tax cuts may not have such a big positive impact on the economy as many people think.
Are you shifting your allocation to ex-US, or you haven't made that decision as a firm yet?
We haven't made this decision yet. I will not talk about specific portfolio allocation here, but there is a sign that something may have changed. What we saw last week in the treasury market and in the dollar is something that hasn't happened in 30 years, except for the week when Lehman Brothers went down in 2008. So we are talking about very unusual moves in the market. And what we're seeing is, as I repeat, is that there is some stress in the treasury market. People are moving away. Global investors are probably seeing treasuries less as a risk-free reserve asset, as more in general as a risk asset. And that has implication because this means that the US may eventually, not tomorrow, but gradually lose its so-called exorbitant privilege.
Right.
They basically allowed the US to run unsustainable fiscal policy for many years without paying the price.
All right, Marco and Andrew, thank you so much.